Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, October 26, 2023. It's 4:21 now, Eastern Time, so markets are closed, and Amazon has reported they are trading up a little bit, pretty decent move, nothing big after hours, and I want to just get my thoughts out to you. All right, so here's where we're at. We are well below that red line on QQQ, which was a significant support level to me. Talked about the hammer probably coming down on the market a couple weeks ago, and that's a pretty good drop. However, I'm still long, added to some longs today, and I'm going to go home long, and especially now that Amazon's out of the way, that feels a little better for tomorrow. So here are the facts. Let me just go over the facts real quick. 200-day, this I have the after-hour trades on. QQQ closed a hair lower than this candle's reflecting, but not much. And so for all intents and purposes, we're right there on the 200. I always say if you have to squint to see if you're on it above it, then you haven't taken out support. And we're as of now just a hair below the red line. Of course, is the 200-day exponential moving average, and so you can say, yep, you took out that red level, but a lot of my purple levels are still, or at least enough of those haven't gone. If you recall, this is something I've been calling for a move down, and then ultimately a break of these levels, and then saying again, this is going back weeks, even months. Predicting we'd get here, and then once this level went, we'd start to see the selling accelerate, and that's certainly what we had. Exactly what we had. Last 2 days collectively were the biggest 2 down days in a long time, and that's what I call kind of impulsive selling, waterfall type selling. All right, why am I long? Well, I may regret this because we hit that point where I said there's just so many red flags lately and yellow flags in the market. And I think the damage has been done. I use the analogy of a hunter or shooting a prey and then not doing a kill shot, and the prey, the damage is done when the bullet, depending on where the bullet enters. If it's not a kill shot in the heart, it's gonna do enough internal damage to the organs. The hunter's gonna have to track down the blood trail, and that animal's eventually gonna die. And I think that's what's happened to the market with these, with everything that's gone on, including but not limited to the higher interest rates. But again, how it plays out, that's the $1,000,000 question. And me, I love to short, love to be short, just like I love to go long. But when you're shorting, you really have to be on your toes at all times, because the counter trend bounces. The snapback rallies are strong and swift. And depending on what your trading plan was, if you shorted any of the multiple sell signals we've had since back here, bounce back to resistance objective shorting ops, and you've got your eye on the prize, these are just, again, initial targets. Turn to my weekly chart, and I have targets to take out the October lows there from 2021. If that's the case, you can ride out a counter trend rally that might go all the way back to, let's just say, this downtrend line right here, and that's well within. Might not feel good at the time, but to give back 7% on your position, again, keeping your eye on the prize for another 30+% drop, it might be worth it. But then again, the active trader, if you can get it right enough, you can turn around and put these counter trend rips to your advantage by covering shorts when you're trading a downtrend. Covering shorts, and then actually not only sidestepping double digit or high single digit give backs, but turning that around and making and profiting from it. So that's what I think right now. That's where I'm at, and so we'll see. And worst case scenario, everything I've been talking about for months plays out, and we just start waterfalling soon. And we might, and hopefully I'll get an opportunity to objectively flip back into shorts for that. And believe me, I still have some core short positions in longer term accounts, but I've built up. I'm net long, if that makes sense. Net long means, as far as equities go, that you have more long exposure that offsets the short exposure. One reason, if it's confusing, why are you doing that? every stock, this is a great time. We've seen there are periods where all stocks go up together. Those are those what do you call it, when the market breadth is very positive and it's a broad-based advance. You have just about all sectors and stocks rising. At that point, you can be all long, or likewise, if it's on a big market sell-off, you can be all short the indexes. However, in a market like this, which we've been topping here, this rally is just clearly stalled and reversed now to the trend to the downside. There's a tremendous amount of profit to be made and alpha, if you will, where you can outperform the market vastly by using proper security and sector selection. What does that mean? Don't be short the REITs right now, for example, when they're looking bullish. REITs have this divergent low here. I'm just picking an example, and let's say they were trending up. But security or sector selection is intentionally being long the most bullish looking stocks or sectors, and then being short the most bearish, instead of just broad index shorts. Broad index shorts are easy, and that's what I try to do, is tell you when my thoughts are on the overall market, when it's time to do that, because you short the NASDAQ 100. Well, guess what? You're long the NASDAQ 100. You're long 100 companies, and it's even better if you go to S&P 500. If you're short along, you're short along 500 companies. So one earnings move against your position on one of those 500 isn't going to kill you, but it is going to dilute your gains down, because and that's the pros and cons of diversification. The more concentrated you get when you shift over to QQQ from SPY, the S&P 500 ETF, covers 11 sectors, broad sectors, 500 companies in there, the largest 500 in the U.S., and all kinds of sectors. And so you have that diversification. But then when you go to QQQ, what it does, the 100 largest in the NASDAQ, and it excludes financials. It has over 50% in technology, so it's pretty much playing the tech sector. Let's just keep it simple and call it for what it is. Yeah, there's some biotech and other things in there, and Starbucks and Booking.com, but again, they don't move the needle as much as tech. So I always say it's about getting it right or wrong. And lately, I've been trading the VIX a lot as well. If you can game the little counter trend moves, the VIX is going to move roughly inversely to the stock market. Okay, let's carry on. So what did we close today? We still have, by the skin of our teeth, positive divergence on the daily charts here of QQQ. QQQ, turn off all the price levels. Very simple. We're just closed the day a hair below the 200 exponential and a hair above the 200 simple. I've many times recently and in the past talked about how significant those levels are. And now that Amazon's out of the way, and you usually don't get, I didn't look at the calendar, but usually there's no big economic reports on a Friday, nor any big earnings either. So we're kind of clear from that aspect, all right, from the news, financial news. And so that if there's going to be a good day for the market to rally tomorrow, I can think of none better, because it's really nothing, so far. I don't think Amazon, they haven't made the conference call yet, but they haven't spooked the markets on the initial earnings. All right, and to carry on and just get to the other big stocks. So you recall for weeks and even months now, I've had purple lines, and on Apple I had two, 170.37 and 166.61. These purple lines on all the big market leading stocks, the Mag 7, whatever you want to call them, were the levels that I said once they go, that's kind of my all-in moment. That's where I think we'll get to that waterfall selling. And we're sitting on the edge, but guess what? We haven't fallen off the edge yet. Apple is by far the largest of both the NASDAQ 100 and S&P 500, so it is the most important. Apple also doesn't report until next Thursday. I have seen many times Apple will drift up or down into earnings, but it usually doesn't make very large moves. In fact, this is one of the largest pre-earnings moves I've seen in a while. It's again next Thursday. I usually put up lines on the chart here. I'll do it right now. You go like this. Look, let's see when. I think I'm almost certain it's Thursday. Thursday the 2nd. So I put that line right there, and that tells me that's when it reports, and you can kind of see visually. Yep, and there was a last report. And Apple has a history of, inflection points after earnings. Sometimes it will continue a trend, in the middle of a bullish trend, they report and continue up. But quite often, and most importantly, when the technicals say so, I've been unwaveringly bearish, from this point up here with Apple with the breakdown. There's a clear bearish pattern, negative divergence. It's been moving lower. So the earnings was the catalyst that kind of got it going. There was a little sell-off in earnings, and then boom, they reported. And it's just like the stock market. It's been in an unmistakable downtrend since, series of higher highs and lower lows. But, okay, where am I going? Well, okay, so the stock, let's say, their earnings aren't as rosy as people were thinking back here a few months ago when they were buying the high. I put out that $3 trillion kiss of death market cap thing that panned out also so far. Very much a kiss of death. And the stock from that point is down, 16%. I think it's going a lot lower in the coming months to years. Unfortunately, that's my take. But right now, I wouldn't want to be short this stock now. First of all, it hasn't taken out my final level right there. And those lines aren't just random arbitrary lines. They're supports. So Apple closed on support. Some glass half full, half empty stuff. There's the 200 days right there, both the simple and exponential, and it made a solid close below both today. So, you can give that a check mark for the bears. For the bears, for the bearish case. However, it closed on support, and it still has some big positive divergences, and you just have to be careful about getting too bearish when you're seeing a lot of positive divergences on the daily chart. If they get taken out in the next week or two, then that just clears the path, in my opinion, for that kind of swift move down to go revisit and probably undercut ultimately those lows from last year. But unless that happens, you have to respect that we're in close proximity to the 200-day moving averages. So, quite often you're going to pierce a little above them for a little bit or a little bit below them. So they're not hard levels. Just as often you do have perfect reversals, off those levels, meaning when you're rallying up to them, you hit one or the other and then get a perfect reversal. That happens a lot as well, but just as often you slightly move above them. So where I'm going, and you take it collectively, you look at the market, you look at QQQ, look at Apple, Microsoft, Alphabet. Are most of those stocks well below their 200s? If they are, guess what? You're in a downtrend. You're in a bearish trend, and you should be looking to sell the rips, short into strength, rallies into resistance. Likewise, when you're above the 200, especially if they've been regained recently after a bear market or downtrend, that's when you want to be in bull mode, buy the dip mode. And so right now, again, we're in close enough proximity to them to not say it's written off with a positive divergence and all that. So like I said, the potential's there. I'm not trying to oversell this rally thing. Like I said, my convictions are not super high because I've been making the case for what's happening now for weeks and months, and it feels a little icky being on the reversing in a kind of positioning for a bounce when we could just tonight futures can melt down. These guys could keep going down. There's no set rule, but again, Apple reports next week. We had a strong GDP number today. We have quite a few at support right now today. Last 2 days, the market can't catch a bid. Every little bounce gets sold into. Every little 5-minute divergent low gets sold into. As I told you the other day, those things tend to stop working once you get to that stage, that impulsive leg down. That's when 5-minute divergences and 15 minutes, they stop working. You really want to look out to the 60-minute and daily charts to see pullbacks to support with positive divergence. All right, let's just look at the rest of the lot. Microsoft, great quarter, I guess. I don't go through the numbers. I'm not doing that this time around. I'm just listening to what others say. But as I, said, and somebody asked today, what are your thoughts? It was still up here. It's gonna trade with the cues. It's simple mathematics. It's not Microsoft's fault. You can be the best company out there, rosy earnings, rosy guidance, everything. But mathematically, it's the second largest holding in the NASDAQ 100 and the S&P 500. And so when they hit the sell button, they meaning everybody, institutions, individuals, you, me, you're taking out of your 401k, you're shorting QQQ or selling it from long. QQQ gets those sell orders and all the mutual funds out there that track the S&P 500, and they have to sell what they own. They don't just sell what they own proportionally; they sell what they own, all weighted cap. And Apple and Microsoft, those guys are back here. Last time I updated the numbers, Microsoft made up 13.25% of QQQ. So if QQQ is getting sold, that's usually going to offset any bullish news, any buying pressure. Those guys and gals that only trade on fundamentals and think a stock is going to go up because they had a good earnings quarter. Well, guess what? The market may have different plans, and it's all supply and demand thing. So ultimately, fundamentals will take a stock where it needs to be, but in the near term, technicals rule the roost. So that's it. Anyway, it got rejected. I think I covered it earlier. I did. 341.12. It failed to. And now it has support here. So this one's kind of pinched between support and resistance. Support there. My purple level's all the way down here. So Microsoft's still fine. And remember, just put in a divergent low recently, broke out of the downtrend line, and it's still above that. So you can't write Microsoft off yet. Alphabet, this one, of all the things, it's the only one I went long today. I might even grab some Amazon after I told you I might, and I'll watch it, wait to see how the dust settles today, maybe pick it up tomorrow. Once the market opens, if things don't crater overnight. But this is a great buy. You notice on most of those Mag 7 stocks, I did have at least two, sometimes three purple lines. I didn't color this up purple, but it very well could have been. It would come in line with the other ones. It's really great support. I talked about it today. Now it hasn't gone anywhere. Stepped in and bought it right here at the bottom of that and pointed it out to you when I got back into my desk this morning, right there. So this is not a successful trade yet. It's just interesting. It kind of held up today, and it closed right on dual support levels, price and the 200-day exponential moving average. So sometimes I just keep a simplistic approach, dumb it down. This is a stock that is down in the past few weeks, although it's very, very much called for it. Very bearish chart pattern, lots of sell signals back here, breakdown back test, 101 reasons to be short all the way down here. But right now I see about not nearly as many reasons. In fact, I weigh the evidence. I think the, RR, it's a risky trade, aggressive, catch a falling knife. If you ever look up the definition of catch a falling knife in the dictionary, open up, you'll see a picture of a chart. It looks just like this. I mean, that is the definition. This thing is in free fall in the last few days, following earnings. But, so I like to say, try to catch falling knives. Sometimes you get cut. You may lose a few fingers, but you can also, if you can pick up, a stock like this, if the market bounces, this one will probably outperform tomorrow. It's down 14% in just a couple, in a week. Down to support, down to the 200-day moving average. Last time, if you bought a pullback to the 200 right here and just tucked it away, now I'm playing a game of tucking away and throwing away the key and selling the high, but it went up 37%. But it was also, after it recovered the 200 days and back tested them successfully, back tested in a trading range back testing, and once it became clear to the masses, i.e. the market, that Alphabet wasn't going to give up that 200, the bulls were successfully defending every pullback to it, then they just took off. They broke above the range, a big grain breakout candle, and the rest is history. So anywho, this is just it. So, and look, and if it falls another 4.5%, they'll probably step in and buy the 200 simple. And if they don't, there's always a potential for a crash. Crashes are very rare. They're very fun and profitable to be trading when you're short. Trust me, I've been in a lot of them, caught a lot of them. And still possibilities there. Trust me, I go to bed tonight. I'll have my stops in place. Hopefully I won't wake up, stopped out to some big, slide down in the futures tomorrow and a big opening gap in the morning. It's certainly possible. So it's not a time to get crazy aggressive long or short is the bottom line. I think I've been saying that the last couple of days pretty clear. But that's it. Bottom line, another stock of the Mag 7 at support. And although I didn't have a purple level there, it's really where one should have been. Amazon, I covered that one today. Played the, hey, what's going to happen after earnings guessing game, and this one was, positive because you have one, two, you have now, and you got a reaction because we hit that. That was a low today. Assuming this thing doesn't tank in the after hours or pre-market session tomorrow, or really, to be honest with you, all that matters are the daily candles. So if we gap down or move down and close solidly below there, remember I have my first targets down here, 114.05. And that's a possibility too, guys. You can see you have the 200 days. You've already taken out the simple or exponential, the red line. Simple's right there, right below current levels. And then what these guys do sometimes, these stocks, they'll punch down through there in a downtrend and then hit a price support. That's a really nice support level. That's an area too, just like I see, from where Alphabet was today, maybe 4 or 5%. This is 3.5% downside, so not that much more. And earnings are out of the way. The trend is bearish. Again, there's just so much out there. I wish I wasn't intermediate to longer term bearish, because then I might be, taking a pretty hefty long position for a longer term trade. If anything, I'm just looking for bounce trades right now, but we'll see how everything firms up. And whether or not we get a bounce, I'm going to continue to monitor those TTW things I'm watching, my things to watch list. I'm very closely watching treasuries, everything. And I'm going to go over some of those things today. So, okay, Amazon just took a drop and tanked down and after hours. See, this is why I say never, ever put too much into the initial react. There's the initial reaction. The numbers hit, algos and some humans buy because they like what they saw and what they were looking for. But then, they get on the phone, they start talking, and all of a sudden, hey, maybe it's guidance. I don't know. I'm not listening to the call, but you can see that reversal. It's still holding where it was, it's still above today's lows. So again, let's move on. We'll see where this goes tomorrow. But again, if they can rally off here, you're going to have a divergent low. You have a downtrend line on a lot of these stocks. It's not only a price target, potential bounce target, but if somehow things really firm up and I start to see a lot of these red flags abate, what would it take? Again, I've been saying for a while, I think the damage is probably irreparable at this time from rising rates. And what I'm referring to is just a lag effect. That's it. I think the wheel's already in motion, and the markets and economy's destiny is almost pre-written. I hate to sound so rigid. I'll adapt otherwise if it proves me wrong. But if it's not, or at least that big move down that I feel is coming in the coming months to years, if it's going to be delayed, then this would be a great case to see a lot of these FANGs, market leading stocks, hold support here, bounce off the 200, see the buyer step in. And then ultimately go on to break out of those downtrend lines, and who knows, maybe we'll even be looking at a marginal new high scenario. We'll see. Right now, the odds have been ticking down on that for the last couple of days because a lot of my purple lines have been taken out. Not all of them. There's the kind of my line in the sand for Amazon, and we hit it today to the button. I haven't adjusted that line. Same line's been there for a while. NVIDIA closed right on, again, a hair below. Again, I have it on post-market, whatever's happened since the market closed. That's about where it closed. That's a 1-minute chart. So there it is. So NVIDIA, and I have a high degree of confidence that this one is headed down. The charts indicate it's headed a lot lower. It's just a matter of when. Is the time already here? And so we'll smash through these levels one after another. But it's big support. That you cannot argue. You have the uptrend line off the October lows. You have the 200-day simple and exponential moving averages right there. You have a massive gap right here. This gap kind of set the tone for the market. The final stage up in the market right there. And that's where that line is. So that is, to me, a massive confluence of major support on one of the most psychologically important stocks. And cap weighted. It's also, it's a $1 trillion company. So it does have a pretty good weighting there in the indexes. But it's just, again, it's kind of the poster child of the AI bubble hype, whatever you want to call it. I don't want to call it a bubble. It's AI's here, but I've already talked on that. AI's been around. It's not anything new. All of a sudden, it just got hyped and played into when ChatGPT came out, and then all of a sudden, people that didn't even know what AI was. Like it's some new invention that happened, a year ago. All right, so there's the levels, and maybe at this point, kind of beating a dead horse. We're heading there. We're just coming off these divergent highs, and look, let me just go back and do one more thing that I haven't done in a while. I was doing the same thing here, talking about these divergences, talking about a bear market coming in the stock market, in these big stocks, when everybody loved them. Everybody loved the FANGs back then, and nobody wanted to short them. Everyone wanted to buy them, and they were going to go to the moon, blah, 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 blah. And so what happens is once the top is in, once these divergences and all these bearish technicals, everything that have been building, I've been talking about, once they start to play out, you get that initial leg down, and then you get what I refer to as the point of recognition, where dip buyers like Pavlov's dogs, the bells ring, they salivate, they buy, but then at some point there's that what I call point of recognition, where they realize, you know what, maybe this time it is different, maybe something else is going on, maybe this stock has topped. And you can see that came in the form of a big gap there. That was an earnings gap on Meta, and then once that happened, that was it. And so, see, this is the risk that's why I'm drawing these purple lines. There is that point, and I'm trying to identify it. I'm giving you levels. It's not a single point. It's kind of that range, and what happens, and you can see it in Apple, and Apple's probably held up probably better than most, but all the big things, they kind of got going and really just started moving lower. You can see it best in the index. There it is. And then the selling began to accelerate, and you got these more impulsive legs down, and then the momentum waned. You had positive divergence in the market bottom. So that's it. So I still think somewhere in here, there's a good chance we're going to get start to accelerate the downtrend. However, I'm giving slightly favorable, a little better than coin toss odds. If it's coin toss, it's 50-50. But not much. I think that we can, if it's going to happen, it needs to happen now. Let me just say that. We have a lot of things that key support. So, all right, I think I covered everything. There's Tesla. I had the lines. I don't know why they're blue here. Tesla was kind of a different beast. Tesla's, all those other stocks were coming off multi-year 52-week high. Tesla's just been in a bear market since back here in 2021, like most everything else, and rejected off the bear market downtrend line. But then most recently I highlighted this triangle, broke down there, and it's been moving steadily lower. But it, like everything else, it's got a pretty good support level. These blue lines right here. So I have a lot of key support levels, and I do think the RR risk reward favors being long right now. It's an aggressive counter trend trade. I may come to regret it. But that's what I see, and it could come. I don't know. I would love to see a big run up in the futures overnight and a big gap up. That kind of what that'll do. Let me show you how my mind thinks. What that'll do is all these what I call JCL, Johnny Come Lately shorts that they didn't want to. This is SQQ. They buy these inverse ETFs, or even look at the Qs and turn off all the lines. They didn't want to short the initial sells, the first bearish rising wedge breakdown there, right off the big divergent high, sell signal one. They didn't want to short that. They didn't believe it. The market was too strong. They didn't want to short that second breakdown of that trend line, that one, or the kickback to the up, any of these kickbacks to the downtrend line, including that one, which was highlighted recently. That's just a couple. What is that? Not even 2 weeks ago, 8% drop. If you took advantage of that. And I'm not trying to sound offensive here to anyone that did short today. I'm really not. I'm just telling you how technical analysis works, at least in my mindset. You have to try to figure what are all the players on the field doing. And I know that, a lot will want to, short when they see things going down because they see a downtrend. And I've never been a trend chaser. I call those trend follower. I try to identify trends before they occur, because if by the time trend chasers or trend traders recognize a trend, they start to position, and that's usually about the time it's over, or at least that wave down is over. So that just never worked for me. I have a different style. I try to get in front of trends, and that's what I'm doing right now, if that makes sense. Like I said, I'll communicate my thoughts tomorrow. We could just smash down. Futures could tank overnight. It gets pretty thin here on on the volume at price histogram. And that's why I kept talking about weeks ago, even months ago. Let me turn up the volume at price histogram and tell you one of the reasons why, among others, that we could see that swift move down. So when you turn on the volume at price histogram, these bars show you the volume at each price level. This is your volume every day down here, these volume bars. And these are the volumes that took place at each price level. So you can see from this line out here, take that across, and that's also not mere coincidence. It's not why I put my red line there. I looked at price support levels and other things, but it lines right up with it. And so now we've entered that thin zone. And these thin zones work a lot like a gap. It tells me, and again, it was that whole NVIDIA earnings and gap up that just ripped the semis and all things tech in a very thin zone. What that means is very few bought it. Very few bought in there. It just happened. Most people, that's what the volume price histogram bars are telling me with clarity, no ambiguity here, that when you go back for the last, whatever I did almost last year here, that besides this big chunk right here where a lot of trades occurred, very few bought here in this thin zone that I just made, and most of them bought here at the top. They bought the highs, and now they're underwater. And knowing that at all points in time, there's the vast majority of market participants are longs. They're not shorts. They're not short sellers. We're kind of a niche thing. Yeah, and short interest has been going up lately, but it's never, you're never going to have, you know, in QQQ or Apple, more shorts than longs, not even close. So that tells me that a lot of people are trapped. They're underwater now. And rightfully so, they should have had stops, you know, and here. So there's probably a cluster of stops that are being hit, and that's what can give you that. So like I said today, we're pushing the red line, and we could just backfill the thin zone, and what does it do? It takes us down to the bottom of that thin zone. I have T4 right there. You can see the bars start to get, the volume of price histogram bars start to get bigger, and this is where, you know, there's a lot of support. So to kind of quantify it for you, if we punch down to T4 and then the next day or so, it's about 6%. If we get to the T5, which are just intermediate term targets, I have longer term targets, but this is if it happens. That's why I've had these here for months, these T1, 2, 3, 4, 5. Well, T1 was here, and we hit that way back when. Because that's where I really doubt we just keep going down. That'd be a full-on market crash. It's certainly possible. We're talking 1929, 1987. It can't happen in the same fashion those did, just so you know, and you don't have to worry about that part because of circuit breakers that were implemented after 1987. So whoever tells you, oh, it's 1980 Black Monday coming up, no, you can't. That was the Dow dropped, S&P 23 or something % in a single day. Yeah, that can't happen anymore. They shut it down. They first restrict short selling, the uptick rule, then they'll actually halt trading. Saw it happen back in the financial crisis. All right, so that's that. So you see where we're at. See what I'm looking at. I like those treasuries right now. Give you an update on that trade today. It was posted for you last week. We broke out. Nothing big so far, but I look at everything as RR, risk reward. I see, positive divergence. And so if this does play out, and I gave you, for more of a trend trade here, there's your down trend line, bullish falling wedge. If it breaks out, and I gave you, again, I said you can look at the 60-minute chart if you want to try to game the squiggles. But if you're just a simple swinger trend trader, 401k investor, maybe time to put some of those money back into bonds. I've been adamant and bearish on bonds, mostly short bonds for a while. And so in 401ks, you can't short them, but you can at least get your money out of there because they're going to go down, they're going to drop, and they have dropped a lot more than the interest they pay. However, if you look at it this way, I said earlier, interest rates, I think, this is a weekly chart. We could have a decent rally in bonds, and that's going to mean one of two things most likely, if I'm right, and this happens. So other than it being a pure play trade, just a different asset class to put your money in, asset allocation. Other than that, if this does happen, it most likely will be one of two things. If it happens organically, so to speak, with interest rates just kind of abating, coming down, inflationary forces, whatever reason, and it does not coincide with that stock market crash, then that should be net bullish for equities. They'll start talking about on TV. You'll see an uptick in mortgages. Everybody waiting to buy a house and waiting for rates to drop back down below 7 now, not hit 8. And so that will certainly, could be the catalyst for a decent counter trend rally in the market to trade long in the stock market, along with bonds. The other thing, as I've talked about, which would be no bueno for the stock market, would be that crash scenario comes, big leg down, hedge funds are, and things I've talked about it. The reason I've been bearish is things are going to blow up. The banks that failed earlier this year, two of the biggest in U.S. history, were just the beginning. I and others that I respect believe that. There'll be more, and that's why I have that things to watch list. Where is it going to come from? The muni bond market, pension funds, a hedge fund, errant hedge fund somewhere, a brokerage firm, a regional bank, you name it. There's 101 places. And so, if that happens and you get the meltdown, you get a flight to safety bid in treasuries, well, stocks could be falling and then this can pan out. So again, it can go up for different reasons. But at the end of the day, I'm only long treasuries because I like the technicals right now. And again, the yields are still high. You look at TYX, it's the 30-year yields yielding 5% on a 30-year, 10 years yielding 4.8, 4.8 and a half. And so that's how I look at things. You go into 401k monies now, maybe park it in there. I think at best we maybe go sideways, and if you go sideways for 6 months or even a year, let's just say hypothetically, then you're collecting almost 5% interest on, and that's just treasuries. 401ks, they have corporate bond funds, and I'm watching those too. And by the way, guys, I don't cover half of what I'm watching every day or a fraction of it, but I'm watching the bond market closely, and I'm seeing I haven't seen credit spreads signaling a red flag. Sometimes they don't, but quite often they do, and that's one thing you want to watch for. Distress in the credit markets. And so far, junk bonds relative, or high yield credit relative to investment grade, i.e. treasuries, is hanging in there. So I just wanted to say that. And that's another reason why I think this market could get a stay of execution on the crash or next big leg down scenario. If I saw, because this isn't my things to watch list, if I saw all of a sudden, junk bonds, and I can go to the Fed's, our FRED, the Federal Reserve site. I track, there's different credit spread charts I'll give you. I just want to let you know right now those are potential yellow or red flags, but they're not glaring or flashing too much. Regional banks held up today. I look at that every day. They were up actually pretty nice. And so these are the things that kind of say, okay, you know what? If I saw, more regional banks, if they just were melting down with like tech stocks recently, I'd say, okay, you can't have a problem in the banking sector and not have it ultimately affect the economy or the tech sector. So XLF was down, but the banks, BKX, banks were actually up. Okay, so the banks are kind of firming up here. You have JP Morgan, the big ones. Citi. Remember, they failed those breakouts recently. What was down big is what we're short. This is what the non-banks, MasterCard, other things that are down that really, I can sit here and talk all day. I'm going to wrap this video up soon. Not a bank at all, but this is one of the tells. Remember, it's in my things to watch list, FedEx and UPS, because they are probably about as good as you can get for a canary in the coal mine for the economy. Because if FedEx and MasterCard start going down, which they have been, and they're dropping before the stock market, what does it say about economic growth? Moving less packages, they're less profitable, whatever the reasons. I know rising oil price doesn't help, but these guys are just, taking it on the chin lately. So again, I can go over all this stuff every day. And look at UPS, and this was a level I highlighted. This one. See the volume of price histogram over here, and I've had this key level here for a while. I've covered this one recently, and even I guess the last update we had this little minor uptrend line right there, and it broke and it boom. So that's no bueno. There is a gap right here. I'm going to put that line there. But I'll continue to watch these. I'm just telling you, the economy is these numbers the government puts out. I don't think they're intentionally fake. I think it's just the nature of the beast. GDP reports and even the employment numbers and all that. CPI we all know is a crock, but either way, UPS is coming up to a gap right there, and but no bueno. So here's kind of the thing. Where am I going with this? I don't have a position right now in UPS, but look, it's probably going to, if the market bounces, probably bounce, come back, and this is trading 101. If you get a pushback, kickback rally to 154.90, that would be an objective short entry for the next leg down to my next target, 123.75. That's about it. I can sit there and go and go and go. I've got multiple monitors I'm looking at with all kinds of watch lists and other things. But I think that's the big stuff I just covered. And, the kind of the takeaway is uncertain times, potential we could have another leg down at this very moment as I speak. Favor a bounce. But we'll see. Amazon's right back down to its session, post-session lows and even the intraday session lows. So that's not great. But remember, it was at the lows today in the regular session. The white here, this is the after hours right here. And this is a regular session. You can see we're right back to where we were, which is still that uptrend line in the 200 days. So this movie will be continued tomorrow in the pre-market session and with the futures trading overnight. And then don't read too much into that. Unless it's a huge move, I would just wait until 9:30 a.m. Wait and see how the market trades in the first. We'll probably know it. We get a fake out move. It might be within the first half hour or so, a little more downside. But like I said, if we can hold up these levels and everything I just spent time showing you, the support levels, if the big tech stocks can hold that and rally, we could have a nice tradable rally, maybe even into all the way into Apple earnings next week. And then if we get that far, one way or another, I'll give you my thoughts then as we head into earnings Thursday after the bell for Apple. Alrighty, this has been Randy Finney with Right Side of the Chart. Have a great day.